Hello and welcome to the Life by Design podcast, brought to you by Strategic. This podcast is all about helping you live your great life. Each episode will feature insights from our Chief Investment Officer, Doug Walters.
Hello and welcome back to the Life by Design podcast. I'm here again with Doug Walters, our Chief Investment Officer at Strategic. And today we're going to start with a little weekly recap from Doug's Weekly Insights. And then we're going to get into another topic that I have a lot of questions on that I keep hearing another word, Doug, and I have no idea what it means. And so we're going to deep dive.
All right. Yeah. We'll be probably both learning along the way.
Yeah, I hope I do. Yeah. Okay, so first up, Doug, if you will, just kind of recap the week. Any high points that we need to talk about?
Yeah, I think it's for a while now, it's been about tariffs. It's been about Fed. It's been about interest rates. And every once in a while, we get a new data point on that front. And this week, we had the Fed making their rate decision, which was to keep rates on hold. So the market seemed to absorb that reasonably well. If we sort of look back from the last time we were talking, the market had been showing a bit of strength. That strength continued through the rest of last week. This week was a little bit more flat, but anyway, seems to be absorbing that. The Fed is really in wait and see mode. They're concerned that the tariffs are going to drive up inflation. And if you lower rates, you're also going to be potentially driving up inflation. So they're staying on hold for now.
So when they stay on hold, is there a timeline or like how long? Just until they determine, or like when they say we're on hold, what is that? I don't know what that means.
Right. Well, yeah. We are expecting, and I say we, I'm talking about the market as a whole. You can look at indicators which will show what we expect for rates for the coming year, and they are implying that we are going to see some rate cuts this year. So when we say they're on hold, for them, that's until next time. But for the market, we're seeing that for this year, we do expect some rate cuts to come through.
Okay. All right. Yeah. That's just, I was like, on hold?
Yeah.
What? Perfect. Okay. So that was kind of the hot topic from this week. The other thing, if you guys haven't had a chance, we do a weekly article. Doug does, the royal Weekly Insights. And this week was a topic called alternatives. And I frankly don't know what that means.
All right. Well, it is a incredibly broad topic. So the idea that alternatives is one thing is false. So alternatives can be anything from the gold that we hold in our portfolios to private equity, hedge funds. You've probably heard some of these terms: private credit, private real estate. All of these things are classified under this big umbrella of alternative investments. Almost anything other than traditional stocks and bonds.
Okay, that's what I was going to ask. Like, what alternative to what?
Yeah.
So when we say alternatives, it doesn't include stocks and bonds. It's basically anything else you could invest in.
Pretty much.
Okay.
Yeah.
For the most part.
It's not an official term. It is a colloquial term that we use to capture all of these other potential investments. Cryptocurrency. We didn't mention cryptocurrency. If you consider that an investment, which you don't, it's, alternative.
Or based off of our last podcast, Star Wars figurine.
Exactly.
That's an alternative investment.
That is an alternative investment.
Then I'm way ahead of the game, Doug.
Exactly.
So an interesting quote from the article that I really liked of yours was, once the domain of institutions and the ultra-wealthy, we've seen alternatives increasingly push down market to the mainstream.
Right. And that's really why I thought it was worth writing something this week. We generally don't suggest that our clients get into alternatives, but we are increasingly seeing marketing pushing down to the retail investor, the wealth investors like you and I, to invest in these alternative investments that are sort of packaged up in a way that's maybe a little bit more digestible for a retail investor.
And is that the reason why it was kind of not part of something the mainstream would know about? Is it the packaging or the complexity of what it was before, and now these firms or investment are packaging it in a way so that I can understand what this is?
Right. Understand, maybe not understand, but have more,
fair enough.
have more, have more access, more easy access. And I should say up front, I'll say two things. Number one, I'm not an alternatives expert, right?
Okay.
And it's as we start to talk about private investments, this is something that I don't consider myself an expert in from a practitioner standpoint. I do consider myself very well read on the academics and evidence of it, which is what is important to us and our investors. But it should say a lot of these investments have a bar that you must clear in order to even have access to them. So you have to have a certain amount of net worth, or you have to make a certain amount. You might hear terms like accredited investor or qualified investor, qualified client. These are all legal terms that these private institutions have to allow, their clientele have to meet these criteria in order to invest in these. So they, just to sort of put it into perspective, let's narrow down what we're talking about with alternatives.
Yeah.
Okay. Let's talk about private equity, hedge funds, private credit, the more traditional, what you think of with alternatives. There is much less legal oversight over these.
Okay.
They are not governed in the same way that an ETF for mutual fund, stock, bond are, right? And that allows the issuers of these to not have the same sort of regulatory bar. But what they do have to ensure is that the person on the other side of the transaction has the wealth to absorb this, the challenges that could come with these investments. So what the regulators have said is, okay, you don't have to meet all of the, the same requirements of ETFs and mutual funds in terms of disclosure, but you must make sure that you're selling this to someone that has a lot of money and can afford to lose a lot of money.
I got you. So basically, it's saying, hey, I'm going to put it in simple terms for myself. If I'm going to go to the casino, I need to dictate how much money I'm going to, or I'm willing to lose, because it's a casino. And so I'm going to say, all right, I'm only bringing $100.
Right.
That's it. That's what I'm willing to lose, is $100. And I'm going to put that in. And I know $100 hopefully won't make or break me for the week or the month. And it sounds very similar to that, saying, okay, whatever the dollar amount is, we got to make sure that you're okay, that you can absorb that it won't hurt you long term.
Right. Yeah. Maybe the analogy is to the high rollers area. I don't know if this is the case. Not a gambler, but I imagine
probably a good.
I imagine there's for some to enter some high stakes poker game.
Yeah, there's a minimum to get it.
You probably have to put up a certain amount of money or show that you have X amount of money. That would be sort of the analogy.
Huh. Okay. I like it. That makes sense to me. So we kind of talked through is that part of the transparency discussion too, is knowing how much you have and how much you're willing to bet, quote unquote, on this?
Yes. Yeah. I think, for me, when I talk about transparency with respect to alternatives, it does tie into that idea that they do not have the same reporting and regulatory requirements that other investments, that more traditional investments do. So that does create transparency issues in that the issuers do not have to disclose everything about what they're doing. A lot of these products, you don't necessarily know what they're what they own or what they're doing at all. They'll tell you what the strategy is, right? They have to entice you in somehow, but you won't necessarily know the details underneath the cover.
Okay, so like in the example of private equity, it's focusing on taking ownership stakes in private companies. Is that?
That's right.
So with that, do we know, from a transparency standpoint, do they necessarily tell you what companies, or they're just saying you have a stake in some highfalutin company that's going to do well?
Right. Generally, you wouldn't necessarily know in advance, but they generally do disclose what they own. So some of it is voluntary, some of it may be required, but they want you to know what you own. So it's not that you would never know what you own, but they don't necessarily have to tell you. And generally, you're not finding out. You're certainly not finding out in advance.
Okay.
But you just don't have the same. There just isn't the same regulatory scrutiny on these investments.
So let me ask you this question while we're on this. What is the difference between ownership stake in a private company and me owning stocks in a company?
In practice, in theory, you're owning companies, right? And they're both companies, and there's no difference between. It doesn't have to be a difference between company A and company B. The differences come in what that ownership looks like in practice. Okay. So with a public company, you have daily liquidity, meaning you can go to the stock market and sell that or buy more at any time you want.
Okay.
Right. And some securities are more tradable than others, but generally there is a market there, and you can go to it and you can ask for a price, and you can go and purchase and sell. With private, what you are usually agreeing to do is to lock up your money for a given period of time, sometimes up to 10 years.
Okay.
So you're giving the general partner, which is what the term used for those issuing these, you're giving them your money, and they're saying, all right, we're going to ask you to lock this money up for 10 years.
Okay.
Give us a long time horizon to make some investments, buy some companies, try to make improvements, and then ultimately you'll be able to cash out 10 years down the road. So you're locked in for a much longer period of time. And generally, there are some ways to get redemptions. Typically, there'll be a period, say a year or 3 years, where you just can't get out at all without penalty. But at some point, they'll say, yes, you can ask for your money, but we won't distribute more than, say, 5% in a given year.
Okay.
So if there's, let's say something, the worst case, something's wrong, right, with the company, and everybody wants out, well, you're only getting 5%
right.
back quarterly, typically is how they term that.
So the idea would be I put in a dollar amount, and in 10 years, if the company does well, that they think as well as they think they're going to do, that I'll have a percentage on my return back. So whatever that percent may look like if the company does well, based on its results and how it does.
Right.
Okay.
Right.
Okay. So what about risk?
So the risks come in a few different forms. One is, again, you are tying up your money. That is both a liquidity issue, but also a risk in that, a personal risk. If you need those funds and you are forced to pull money out ahead of the allotted timeline, you could be facing penalties or just not be able to access that money. So that is certainly a risk. Again, the transparency is a risk, that you are not necessarily fully aware of what you're investing in or what the plan of those funds are. Oftentimes, if we're talking private equity, there's typically smaller companies, and often there is leverage involved, meaning they're going to take on a bunch of debt to try to turn this company around or do something new with it. And debt or leverage is always introducing an extra level a risk.
Mm. Yeah, and so it's just it seems like a lot of things beyond your control.
Yes. Yeah, it's a leap of faith. It's a leap of faith, and you are primarily investing in a track record of a management team that you trust. That's sort of the tends to be primary thing that you're looking for, right?
Yeah.
It's track record. This company has had success in turning businesses around. I'm going to trust that they're going to be able to do that with this latest tranche and go for it.
Okay. So that makes sense. So besides the risks, what's the cost of doing this?
Yeah, I think that is probably, I didn't mention it as a risk, but ultimately, if we're talking about, performance and getting your money back, the cost is very high.
Okay.
And I think the average cost for private equity is somewhere around 3.5% to 4%. And if you compare that to, say, owning the S&P 500 through, a Vanguard index fund or something like that, where you're paying 3 basis points, 0.03% versus 3%.
Yeah.
It is a very hefty fee and a very high bar for that management team to jump over in order to get you a return on your money.
Right. So they would, at a minimum, have to do enough good with this company to not only meet that 3 or 4%, but ideally succeed it, right?
Right.
So that's a lot of work.
Yes. Yeah, it's not easy. And at 3 or 4%, I would say is even on the low end. It's, again, do a lot of reading on this subject and you see different numbers out there. 3 to 4% is a commonly quoted number. I've seen others, depending on if you're talking about, a buyout or venture capital or some other type, numbers as high as 8%. So 8-9% is not uncommon. And again, we're talking about an enormous bar to jump over before you're getting your return, a positive return.
So with everything we just heard, what's the track record been for these private equities?
It really depends who you ask.
Okay.
I have seen research, I would say, on both sides of that answer, but for the most part, the research that I've been able to pull together and validate seems to show that most companies most funds are not clearing that cost hurdle. In other words, you're not doing any better in these private investments than you would do in a equivalent public investment. And it also varies by type of alternative. So we're talking a lot about private equity. Again, there's others. There's private credit. There's real estate. There's infrastructure funds. There's all sorts. Private equity actually is the one with the best track record. So if we're going to focus on the one that has had the best track record, then private equity is where you want to focus. And there are some studies that show that they have generated some outperformance over time. The caveat to that is outperformance versus what? So
okay.
If it's versus, and a lot of these studies are saying versus the S&P 500. And, an investor might say, great, I want to outperform the S&P 500, so give me some of that private equity. That sounds great. The problem is that these, again, we talked about risk. The risk profile of these investments is a lot higher than the S&P 500. And there's a really interesting study out. At least I find it interesting. You can hold your judgment. But basically showed, if you think about private equity as a whole, a lot of times they're looking for undervalued assets. They're looking for cheap value companies where there's a potential for turnaround. As I mentioned, they're going to raise a lot of debt. They're going to put that money into trying to turn this business around. So it's smaller companies there's value involved, and there's leverage involved, meaning they're raising a lot of debt to try to do this. If you were to buy a basket of smaller value companies and you introduce a bit of leverage to that, and I'm talking in the public space, you can replicate the return, that outperformance of private equity without the excess fees, without having to lock up your money for 10 years. So this pretty interesting piece of research that I think is really puts it in perspective for me. Again, private equity, there's a key word there. It's equity.
Yeah.
Right. You are just buying, in the end, you're just buying companies. And what profile of companies? Generally, you're buying small value leveraged companies. You can do that in the public space. So why tie up your money?
So it really sounds like, and I think you wrote something to this degree. It sounds like that the ones collecting the fees are actually the ones actually making the money out of these. They're doing great. And there's a subtle point to make as well as for what I'll call the retail investors. You and I who might be looking to purchase one of these funds on these these platforms that are popping up, making them accessible, is we're not necessarily getting the cream of the crop from private equity. The multi-billion-dollar pension funds, the $200,000 endowments, think Harvard. They have a level of access and a level of selection with these private equity managers that the average person doesn't. So you have to understand that we are not necessarily, and I say we, I mean everybody outside of those biggest players are not necessarily getting the cream of the crop. So based on that and our quote at the top, it sounds like there's still a domain of institutions and ultra wealthy. We're just getting some sort of access to it, but it's still maybe a couple steps away from us.
Right. And if you're feeling like, oh, that stinks, that these big players getting everything, I wish, too bad we're not, we, again, the collective, everybody else in the world don't have access to these. I can make you feel a little bit better. So there's another piece of research that came out that looked at the correlation of use of alternatives by these large endowments and pension funds and performance. And it turns out that the bigger the pension fund, the more alternatives they use and the lower their performance. So there was really high correlation between the use of alternatives and performance, but it was the wrong one. The more alternatives they put into their portfolios, the worse their overall performance. And so if you feel like you're missing out, you're not. All
right. Well, I think that's a good place to end this, Doug. So, for those of you listening, hopefully we're going to keep doing these where we pick these topics that we have questions on. They go, I don't know what that means. And hopefully we can explain it to you. Or, well, Doug can. I'm just going to ask the questions.
Yeah, we'll do our best.
All right. Well, thanks, Doug.
All right. Thanks, Jay. Take care.
This podcast is for educational and informational purposes only. Please see the full disclosure in our show notes for more information.